Andreas, you know the quote of Karl Farkas? With thinking and finance, sometimes thinking is lacking. Do you think because of greenwashing? That's a good point. It is extremely difficult what is really green. So seeming is more important than being. That's what Karl Kraus says. Most of the ESG funds are investing in fossil fuels. Is this on purpose? You can see who invests when you see the reports. Greenwashing exists. That leads to confusion. Or do you mean the current ESG backlash? In the US, it's attacked as being vogue, and in Europe, it's suffering through the greenwashing crisis. And this was a problem for the regulations. I don't think about fashion or different criticisms. I'm talking about subsidies. So subsidies or financing of projects, this does makes a difference. So public green finance is effective, but I'm speaking about the private sector, market-based green finance. There are different finance instruments that can be green bonds, green funds, green assets. So if a company is green, you can say the assets are green of this company or the shares. So if we assume that there is no greenwashing and all these finance measures are transparent, are labeled correctly, if we have no doubt that green investment goes into green investments and could go into decarbonization. So assuming we don't have greenwashing, we have these finance measures for investors and also for companies. What effect does it have? Are we gonna have a faster transition? If companies report this, and at least we have attention on this topic. So it's marketing, so to say. So if it doesn't help, it doesn't do harm, but it is connected to costs. Let's think about the data generation, the reporting. Is this label green finance having an effect? Transparency does cost something, and certification as well. The company should evaluate their own potentials with these reports and improve their strategy. But the question is, if green finance doesn't only create a good conscience, if it's only well meant but not actually a good measure. So how can we say green finance, private green finance is effective? We have a lot of promises out there. Green finance would be effective if it gave an impulse to the transformation. So if these companies can have more and cheaper capital, more or cheaper, it's actually the same, because cheaper capital is more capital. It is an incentive to change habits or to change actions and to finance green transition. So it's effective if companies get more capital than if they buy green, if they act with green finance, than if they didn't. And that's what we mean if we speak about additionality. So it should be an additional impact. An additional impact to what we have if we don't introduce this measure. So that means companies who don't follow green finance rules do get less capital. So if we simplify it a lot, capital costs are driven by risks, financial risks. So if the risk is higher, investors expect a higher return. If you wouldn't invest into something very risky, if you wouldn't expect a lot of return. So the return for investors is the capital costs for companies. My bank assessor says about the magical triangle that are 3 goals: rentability, safety, and liquidity. But you mean that we can reduce this to risk and income. So the capital costs are lower if companies have a new risk introduced, which is the green risk. So if the publication or the reporting or green bonds uncover a risk that wasn't seen before, if that's the case, through green finance, the 2 companies would move apart on the scale, and then the green company makes debts on a cheaper way than the other company. Or maybe investors do not get as much money through green projects. But do we have moral investors on the finance market? Yes. We have asked the Austrians, 29% would be ready to earn less through their investments if it's through humanitarian and sustainable projects. So 42% are not ready to do that. And it's one thing to be moral in a questionnaire, and then to act in that way is a completely different thing. Different experiments show that morals are reduced in every round because they're disappointed. And these are usually questionnaires in private households, in retail investors, but then we have, for example, the pension fund, and that's different, I guess. A lot of institutional investors have sustainability in their mandate. For example, the Nordic pension funds, they need to invest on the long term. And we have numerous ESG funds and a lot of people who invest in them. I'm part of them. The ESG funds are not marketed with come to us and you will earn less. They're marketed with a lot of income. They are marketed with doing well by doing good. So it's not about morals. So a small part of the people and a smaller part of the money are willing to earn less. So that would mean doing a little bit less well by doing good. But the fundamental question is still open. How can we promise a better performance by having lower return on investment? I don't know, but at least we have a few moral investors. How can these moral investors lead to lower income or capital costs for companies? They buy shares from green companies, even if they're expensive, and give less return on the investment. Or maybe to not give, or maybe divestment. By tilting to do a little bit of divestment. Divestment is also kind of an investment. If I take out a non-green company from my portfolio, then I don't get a share from their returns. Or maybe a dialogue with the company, so you can start a dialogue in order to convince the company to invest into green practices. So this is a call to action to the societal responsibility of that company. They need to go beyond their own benefit, because the company alone is not, because a company has a responsibility that goes beyond. But if you want to enter into a dialogue, how can you make sure that they listen? Well, because you invest in them. So if you do engagement, you also waver on your return, and that creates costs. So to conclude, so moral investment, investors who waver in their return or in their yield, they can use divestment to reduce the cost of green practices in companies. These investors can exist and they can have the effect. But does it work that green companies get cheaper capital? Some studies prove that. But you said there are only few moral investors, only a very little bit of moral investment. So the majority of the investments are not immoral, but they are cynical, let's say. They are just working for their return. So if I'm a cynical investor, what I'm not, of course I'm not a cynical investor, I'm not an investor at all, but if I was a cynical investor, I can see here a clear investment opportunity. So the windmill offers only very little return, and the coal mine offers a lot of return. And if I invest into the bad company, so to say, I have the arbitrage, and the gap closes. So we should work, the companies of course work for the shareholders, also for the other stakeholders, but let's get back to science. We have theoretical papers that show the positive effect on the environment, and green bonds I think are a good example. We have green emittents that have green and non-green shares. The risk is the same. The difference in price between the green bond and the non-green bond is a good measuring point to see if there is a difference on the capital costs for a green company and a non-green company. So on the primary and on the secondary markets, the difference is very small. There is a difference, but it is 100th percentage, and it costs money, so there's not a lot of incentive for green projects. Maybe the moral investment doesn't have a lot of has a lot of effect, except the warm glow, so the good feeling connected to them. But what about the risk? Maybe that's the decisive motive or driver for change. Green finance, the question is, do green finance products have a lower risk? Brown companies are funding climate change, and that bears a huge ecological risk, heat waves, droughts, and that reduces productivity. But these physical risks affect all companies, all people, no matter if they were emitting a lot or little before. So I don't think the physical risk of a brown investment is not bigger than of a green investment. But the transition risk does correlate with a company being green or brown. For emission intense companies, there's no room in a decarbonized world. They need to change, or they need to, or they will disappear. But it depends on the time horizon, because if all of these rules, the CO2 tax, for example, come in later, then a very polluting company can still make a lot of profit in the next couple of months, years, and then they get still capital in the next couple of years, and therefore the risk is very low. And therefore we have the transition plans, because the investors need to know what their business model can look like, how they can, what it can look like in a climate neutral world. That's in the long-term interest of the investors and of the companies. Yes, you're right. If that is transparent, if it's easy to compare, then transition plans can unlock that, or show that transition risk. So our analysis doesn't support private green finance. So at least we don't know if the preference channel works. As long as we have cynical investors on the finance market, if all investors were moral, then it would be a different story, but then we wouldn't be in that situation. The risk channel might work, but the physical risk affects all of us. It affects all companies. And that would lead to climate adaptation and not climate protection. For transition risks, green finance is a transition mechanism. The actual driver is climate policy. Climate policy of the future defines the transition risks together with technology and consumer preferences. But if the green finance risk is considered, then we have an incentive to decarbonize. We have a broad consensus in the economic literature that CO2 prices are the most effective measure. They're not very popular, but it exists in Austria and the EU, but the price is still too low. A high price would be the most effective pillar for green finance itself, because then private capital will be mobilized for climate protection. Today, you earn money on emissions, too much money on emissions. That should change. I think private green finance alone will not be able to achieve that. To end with Fritz Grünbaum, a conferencier, is one that a speaker wants to, has a task of conveying the very serious situation in a very fun way to an audience. So you can use this QR code for your feedback, also via email or during the break. Thank you very much.